JPMorgan Chase's $50 billion buyback risk urges business leaders to strengthen capital strategy and secure enterprise resilience. You might think the Federal Reserve's stress test victory lap means clear sailing ahead, but if you treat a regulatory minimum as your ultimate destination, you are fundamentally misjudging strategic risk. When you look at JPMorgan Chase leading the charge with a massive $50 billion buyback and a 10% dividend hike to $1.65 per share, you are seeing a masterclass in financial engineering that simultaneously sets a massive, high-stakes precedent for future capital expectations. If you look at Wall Street's aggressive post-stress test cycle, you will see Goldman Sachs jumping dividends by 11%, Wells Fargo by 11%, and Morgan Stanley boosting theirs by 15% alongside a whopping $20 billion repurchase plan. You cannot afford to ignore the staggering scale here. JP Morgan alone commands an incredible $4.6 trillion in assets within a massive $25.5 trillion U.S. banking industry, meaning your capital decisions don't just affect your shareholders. They dictate broader market liquidity and credit capacity. While your financial metrics look fantastic on paper, L-Impact Solutions reminds you that financial engineering does not automatically expand your operational productivity, protect your assets, or modernize your legacy tech architecture. You need to realize that with global cybercrime damages projected to surge past a jaw-dropping $10 trillion annually, every single dollar you deploy toward a short-term stock buyback carries a heavy opportunity cost of delaying your zero-trust architecture or critical AI underwriting infrastructure. If you let your investors view these massive distribution programs as recurring, permanent commitments, you are putting your board under immense pressure because cutting back a buyback during a sudden economic downturn will be interpreted by the market as a major sign of weakness. The reality is that your digital-first competitors are investing aggressively in automation and data analytics, forcing you to treat talent acquisition for AI engineers and cybersecurity experts as a high-stakes capital allocation decision rather than a mere operational expense. To protect your enterprise resilience, L-Impact Solutions strongly advises you to replace static budgeting with rolling, multi-year strategic scenarios that aggressively model localized commercial real estate collapses, interest rate shocks, and sudden liquidity crunches. Ultimately, your long-term market survival relies on a balanced scorecard where executive incentives are tied directly to data quality, cybersecurity maturity, and sustainable value creation rather than just chasing an inflated earnings per share metric. Will today's buyback limit tomorrow's strategic flexibility? Comment below. For the full strategic analysis, visit our business consultancy website, link in the description below. Thank you.